Right now, gold and silver are snapping higher, and this move did not come out of nowhere. In the last few hours, the U.S. quietly confirmed a $12 billion critical minerals stockpile initiative, and the metals market is reacting immediately. Silver was just smashed, gold was leaning heavy, and now both are reversing hard. This is not a random bounce. This is policy-driven demand meeting a paper market flush. Let's break this down fast. I'm recording this on Tuesday, February 3, 2026 at 11:30 a.m. here in New York City. Drop a comment and let me know what time it is where you're watching from. I'm always interested to see who's tuned in live at this hour and who's catching the replay later. And before we move on, a quick note. The analytics show that a lot of you watch these breakdowns regularly, but haven't subscribed yet. If you're getting value from this macro perspective, consider hitting the subscribe button. It genuinely helps support the channel more than most people realize. Let's get one thing straight immediately. This $12 billion U.S. critical minerals stockpile announcement is not about climate policy. It's not about electric vehicles. And it's definitely not about long-term sustainability narratives. Markets are far too experienced to fall for that framing. What this move represents is state-level urgency, a recognition that access to raw materials is becoming a strategic vulnerability, not a commercial inconvenience. When governments start talking about stockpiling, they're admitting something very specific. They do not trust future supply. This is not procurement. This is not routine inventory management. This is defensive accumulation. And history is very clear on this point. Whenever governments move to secure physical resources, precious metals front-run that decision. Not because gold or silver are officially included in the program, but because markets understand what kind of environment produces stockpiling behavior in the first place. Stockpiling only happens when supply chains are fragile, geopolitical risk is rising, and future access is uncertain. That environment is bullish by definition for hard assets, especially monetary metals. Gold responds first because it sits at the top of the confidence hierarchy. It's the signal metal. When gold stabilizes or rises in response to policy action, it's telling you that institutional players are recalibrating risk, not chasing price. Silver follows because it sits at the intersection of strategic material, monetary asset, and industrial necessity. That combination makes silver extremely sensitive to state-driven demand signals, even when it's not explicitly named. This is why the market reaction matters more than the press release language. The U.S. didn't just announce spending, it announced intent. And intent is what markets trade. The intent here is clear. The U.S. government is preparing for a world where resource access cannot be assumed. That is a major shift. For decades, the assumption was abundance, cheap inputs, globalized supply, just-in-time delivery. That model is breaking down. We're now moving into a framework where redundancy matters, domestic control matters, and physical possession matters. The transition is deeply uncomfortable for paper markets because paper pricing only works when confidence is stable. Stockpiling signals the opposite. It tells you policymakers are no longer confident that markets alone will deliver what's needed at the right time, at the right price. And once that realization sets in, price suppression becomes much harder to maintain. That's why gold didn't sell off on this announcement. That's why silver didn't stay down. The market read this correctly. This is not a growth story, it's a security story. And security-driven policy always benefits assets that cannot be created digitally, cannot be scaled instantly, and cannot be replaced easily. Gold and silver check all three boxes. That's why this move matters. Not because of the dollar amount, $12 billion is not system-breaking on its own, but because of what it reveals about decision-making at the highest levels. When governments start accumulating materials, they're quietly admitting that the future looks less predictable than the past. Markets are responding to that admission in real time. And this is why the rebound you're seeing right now should not be dismissed as a technical bounce or short covering rally. This is the market repricing risk in response to policy behavior. And once that process starts, it tends to continue. Not in a straight line, but in sharp, uncomfortable moves, exactly like the one unfolding right now. To understand what's happening right now, you have to understand what happened just before this move. Silver did not drift lower. It did not roll over gradually. It was driven down. The sell-off that preceded this rebound had all the hallmarks of a forced liquidation, not a natural repricing of risk. Volume spiked, price dropped fast, and liquidity thinned out exactly when selling accelerated. That combination matters. When markets sell because fundamentals deteriorate, price moves are usually measured. They develop over time. There's debate. There's hesitation. Buyers step in at intervals. That is not what we saw in silver. What we saw was a sudden wave of paper selling, hitting futures markets with enough size to push price through key levels quickly, levels that had been holding for weeks. That kind of move isn't about discovery, it's about positioning. Once those levels broke, stops were triggered automatically. Margin requirements tightened, and leveraged players were forced to sell into weakness. This is how forced moves work. They feed on themselves, not because the market believes silver is worth less, but because participants lose the ability to hold positions. That distinction is critical. Silver is uniquely vulnerable to this dynamic because it trades in a market where paper volume vastly exceeds physical supply. A small number of contracts can move price disproportionately, and liquidity can disappear very quickly under stress. When that happens, price stops reflecting demand and starts reflecting balance sheet pressure. That's what pushed silver lower, but here's the part that matters now. Forced liquidations end suddenly, they don't taper off, they don't resolve smoothly, they end the moment the last weak holder is flushed out. And once that happens, selling pressure evaporates, sometimes in a matter of hours. That's when rebounds begin. Not because sentiment improves, but because there's no one left who has to sell. The market shifts from being supply-heavy to supply-starved almost instantly. That's exactly what we're seeing now. As price stabilized, it became clear that physical buyers were still present, industrial demand had not changed, and underlying interest had not disappeared. The only thing that vanished was forced selling. That's why this rebound is sharp. When silver rebounds from a forced liquidation, it doesn't drift higher, it snaps back, shorts rush to cover, traders who missed the flush chase entry. And liquidity returns on the upside faster than it left on the downside. This is not unusual in silver, it's structural. Silver has always been a market where downside moves are violent, and reversals are even more so. The key takeaway is this. The decline did not represent a verdict on silver's value. It represented a temporary imbalance caused by leverage. Once that imbalance corrected, price was free to respond to real signals again. Signals like government stockpiling, rising geopolitical stress, and tightening physical availability. That's why the rebound aligns perfectly with the policy announcement. The policy didn't create demand out of thin air. It activated demand that was already waiting. This is what happens when paper pressure collides with physical reality. The paper market can push price down, briefly, but it cannot suppress demand indefinitely. Eventually, something breaks. In this case, it was the selling pressure itself. And when that breaks, silver moves fast. That's what you're watching unfold right now. While the paper market was pushing silver lower, something very important did not change. The physical market held its ground. That disconnect is not a side detail. It is the core signal. In a healthy, well-balanced market, paper prices and physical demand tend to move together. When price falls, demand usually softens. Buyers step back, inventories rise, premiums compress. That is not what happened here. As futures prices dropped sharply, physical indicators refused to follow. Premiums stayed firm, deliverable supply stayed tight, and demand, particularly outside the Western paper system, remained active. This divergence tells you the sell-off was financial, not fundamental. Nowhere was this more visible than in Asia. Shanghai pricing continued to show resilience even as COMEX futures were under pressure. That matters because Shanghai reflects real metal moving through real supply chains, not just leveraged contracts changing hands. When Shanghai holds up while Western paper prices drop, it's a warning sign. It tells you that price is being set by liquidity stress, not by a collapse in demand. China, in particular, has been a consistent buyer on weakness. This is not speculative behavior. It's strategic accumulation. Chinese buyers tend to step in when prices fall to levels they consider disconnected from long-term fundamentals. They are less concerned with short-term volatility and more focused on securing material. That kind of buying doesn't show up immediately in futures volume. It shows up in inventory drawdowns and persistent premiums. And that's exactly what we saw. The physical market simply did not validate the paper sell-off. This is critical because silver is not just an investment asset. It is a working material. It's used in electronics, energy systems, medical applications, and industrial processes that cannot easily substitute away from it. Those demand channels don't disappear overnight. They also don't respond to futures volatility in real time. So when paper prices drop quickly, but industrial and strategic buyers continue taking delivery, you get a growing imbalance between available supply and quoted price. That imbalance can persist for a short period, but not indefinitely. Eventually, physical reality forces a correction. This is why watching premiums matters more than watching spot price during sell-offs. Premiums tell you whether metal is actually available at the quoted price. In this case, the answer was increasingly no. Dealers did not suddenly find themselves flush with excess silver. Fabricators did not cancel orders. And long-term buyers did not walk away. The system absorbed the paper pressure without breaking. That's why the rebound was primed. Once the forced selling in futures ran its course, price was no longer anchored by artificial pressure. It was free to move toward where physical demand had been signaling all along. The current move higher is not creating that demand, it is catching up to it. This is a crucial distinction. Markets that rebound because sentiment flips are fragile. Markets that rebound because physical demand never left are structurally supported. Silver is showing the second behavior. This also explains the speed of the move. When physical demand remains intact during a sell-off, it creates a coiled spring effect. The moment paper pressure eases, price has to reprice quickly to reflect underlying tightness. That repricing doesn't happen smoothly. It happens in sharp bursts, which is exactly what we're seeing now. The takeaway here is simple but powerful. The physical market never agreed with the sell-off. And when physical markets disagree with paper markets eventually lose. That's not ideology. That's how commodity markets have always worked. Silver is reminding traders of that fact in real time. In moments like this, it's important to watch which metal moves first. Gold moved first. That alone tells you this was never just a silver story. Gold is the market's early warning system. It responds before panic shows up in headlines and before stress becomes obvious in broader markets. When gold stabilizes or turns higher ahead of silver, it signals that risk perception is shifting at the institutional level. That's exactly what happened here. As silver was being forced lower through paper liquidation, gold stopped falling. It didn't collapse. It didn't accelerate downward. It held its ground. That was the first clue. Gold holding steady during stress tells you that large players, central banks, funds, and long-term allocators are not selling into weakness. They are watching. They are waiting. And in many cases, they are quietly accumulating. Once gold began to edge higher, the message became clearer. The market was reassessing risk, not embracing confidence. Silver always reacts second, but when it reacts, it does so with leverage. That's because silver sits in a unique position. It shares gold's monetary sensitivity, but carries additional volatility due to its industrial role and thinner liquidity. When conditions shift, silver tends to over-respond. So when gold turns, silver doesn't just follow, it accelerates. That's what catching up looks like. You can see this most clearly in the gold to silver ratio. During the sell-off, the ratio stretched higher as silver underperformed. That expansion reflected stress, not strength. It told you silver was being punished more than gold, a classic sign of forced positioning. But ratios don't stretch forever. Once gold stabilized and silver selling pressure exhausted itself, the ratio stalled. That stall is critical. It marks the moment when silver stops being a funding source and starts becoming an opportunity. As the ratio begins to roll over, silver typically outperforms gold on the upside. That's the phase we're entering now. This shift is not speculative, it's mechanical. Gold's move validates the environment. Silver's move magnifies it. The current price action reflects that relationship in real time. Gold is signaling caution, currency stress, and policy uncertainty. Silver is translating those signals into speed and volatility. This is why watching gold first always matters. If silver had rebounded without gold stabilizing, this move would be suspect. It would look like a short covering rally with no foundation. But that's not what happened. Gold laid the groundwork. Silver is now responding. That sequence makes this move far more credible. It also explains why silver's rebound feels sudden. Silver doesn't creep higher once gold leads. It snaps into place, rapidly repricing to reflect what gold has already been signaling. That's the behavior you see at inflection points, not at the end of moves. The takeaway is straightforward. Gold confirmed the shift in risk. Silver is now catching up, fast. And historically, when that happens, the silver move is rarely finished in a single burst. It's important not to misread what's happening here. This move in gold and silver is not the result of a chart pattern resolving itself. It's not a moving average crossover, and it's not a routine oversold bounce. This is a policy-driven market response. That distinction matters more than most people realize. Technical bounces tend to be short-lived. They occur because traders recognize stretched conditions and temporarily step in to capture mean reversion. Once that trade plays out, momentum fades and price often drifts back toward where it started. That is not the behavior we're seeing now. This rebound is happening on the back of a government decision. Specifically, the announcement of a $12 billion strategic stockpile for critical minerals. When markets respond to policy action, they are not reacting to price. They are reacting to intent. Policy tells the market how governments are reading risk. It reveals what policymakers are worried about and what they are preparing for. And right now, the signal is clear. Governments are no longer comfortable relying on frictionless global supply chains. That discomfort translates directly into demand for assets that sit outside the financial system. Gold benefits first because it functions as a confidence hedge. Silver benefits next because it exists at the crossroads of monetary trust and industrial necessity. This is why labeling this move as a technical bounce is dangerous. It encourages complacency. It suggests the rally can be ignored or faded, when in reality the forces behind it are structural. Policy-driven moves tend to have three defining characteristics. First, they override technical signals. Markets can stay overbought or oversold much longer when policy is involved, because price is adjusting to a new framework, not a short-term imbalance. Second, they attract different participants. This isn't just traders stepping in, it's long-term allocators, institutions, and entities that care about security more than entry price. Third, they change expectations. Once policy enters the equation, the future is no longer assumed to look like the recent past. That's what we're dealing with now. The $12 billion figure itself isn't the key issue. The issue is the precedent. Once one major government openly commits to stockpiling, it increases the likelihood that others will follow, either publicly or quietly. That creates a competitive dynamic. And competitive accumulation is fundamentally bullish for scarce resources. This is why the rebound has depth. It's not just price snapping higher, it's the market repricing the role of metals in a more intervention-heavy world. In that kind of environment, volatility increases. Moves become sharper, and corrections tend to be brief and violent rather than slow and orderly. That favors assets like silver, which respond aggressively when underlying assumptions shift. The market is not trading indicators right now. It's trading policy behavior. And policy behavior is telling us that risk management is moving from spreadsheets to stockpiles. That transition is subtle, but when it shows up in price action, it matters. This move should be understood for what it is. Not a technical relief rally, but a policy-anchored repricing, and those rarely end where they begin. The most revealing part of this move isn't just that gold and silver rebounded, it's how fast they did it. Markets with deep liquidity and excess supply don't move like this. They absorb shocks. They digest news slowly. Price adjusts in stages. That's not what we're seeing here. The rebound was immediate. It was sharp, and it left very little room for hesitation. That speed tells you something critical about the underlying system. It tells you the market is tighter than it looks. When a single policy announcement can flip price direction this quickly, it means there isn't much slack left. There aren't deep inventories waiting to be sold. There isn't a large pool of willing sellers standing by. Instead, the market is operating close to its limits. This is especially true for silver. Silver trades in a structure where the visible supply, futures, contracts, ETFs, quoted inventories, often gives the impression of abundance. But that abundance depends on confidence and participation. Once confidence wavers, supply can vanish almost instantly. That's because a large portion of silver supply exists only as a promise, a contract that assumes future delivery under normal conditions. When conditions stop being normal, those promises become fragile. This rebound is exposing that fragility. The market didn't need a massive shock, it didn't need a financial crisis headline, it only needed a signal that governments are preparing for stress. That was enough to trigger repricing. And that tells you inventories, both visible and invisible, are far thinner than pricing models suggest. Gold is showing the same dynamic, though in a more controlled way. Gold markets are deeper and more disciplined, but even there, the response was swift. Gold didn't hesitate. That's important. It suggests that buyers were already positioned, already watching, and ready to act the moment the narrative shifted. In tight systems, price becomes hypersensitive. Small inputs create outsized reactions. That's exactly what we're witnessing. The rebound isn't being driven by euphoria. It's being driven by scarcity awareness. Participants are realizing that if conditions deteriorate further, geopolitically, financially, or in supply chains, access to metal may matter more than entry price. That mindset changes behavior quickly. It reduces selling, it increases hoarding, and it shortens time horizons. When that happens, volatility doesn't decrease. it accelerates. The current move should be read as a warning, not a celebration. It's the market telling you that the margin for error is shrinking. In systems with excess capacity, stress leaks out slowly. In tight systems, stress releases in bursts. Silver's history is full of these moments. Long periods of compression followed by sudden, violent moves that seem to come out of nowhere, until you look underneath and realize the system had been stretched thin for a long time. That's where we are now. This rebound didn't fix the underlying tightness. It revealed it. And once tightness is exposed, it doesn't go away quietly. It shows up again and again in sharper pullbacks, faster rallies, and increasingly unstable price action. The takeaway is simple. The system doesn't have much cushion left, and when cushions disappear, markets stop moving politely, they move fast.